I don't know if, can two people record it at once?
It says recording.
Are you able to do it too?
Yes.
I am.
Annette, you're doing it as well?
Yeah, I'm recording as well.
Okay, good.
That way we have a backup in case I do it wrong.
I'm sure you've done it fine, but I just want to have a backup. You can go ahead and start. I'm going to mute myself. Hello, everybody.
All right. Okay, well, welcome everybody. My name is Annette. I'm on Aunt Dar's team, and Doug McMillan has been a family friend for a lot of years, and he has done my my small business taxes for, I don't know, 10, 11 years. I feel like it's been a while. And so he has been a great mentor when it comes to this, and he always gives really good advice. And so I asked him if he would join us for a meeting to kind of give us the do's and don'ts of the tax world in as a small business or as a in-home business. So I'm sure he has some great insights to share, and then also he will open up the floor for questions if you have nearing the end. So if you have questions throughout, please feel free to jump in if you want to, or save them for the end, and I will turn it over to Doug. So go ahead, Doug.
Thank you, Annette. I've been a CPA for almost 30 years. Most of that time working in the small business and individual taxes. I've been self-employed myself for the last 25 years. So I know all about small businesses, self-employment, that type of stuff. Most of my clients now, a lot of them are self-employed. So I deal with this all the time. And I find a lot of commonalities no matter what kind of business they're in. Just common issues and concerns. One thing I need to say kind of up front, my professional ethics and IRS regulations pretty much prohibit me from giving personal tax advice over this type of venue. Generally, I have to write it down, send a letter. There's a lot of documentation. So everything I'm talking about tonight is going to be pretty general, somewhat basic, but I can certainly answer more specific questions. Just I can't really give anybody specific tax advice. So tonight's agenda, I've got 3 points on it. One is we're going to start at the beginning. We're talking about taxes, but really taxes is the end goal. The beginning is bookkeeping. So we're going to talk about the best practices in bookkeeping, keeping records. Then we'll talk about tax implications and tax issues related to self-employed people. And then we're going to talk just a real short thing about how to find a good tax preparer or advisor for you. And then we'll open it up to Q&A. So starting at the beginning really is bookkeeping, record keeping. Everything related to tax is based on the records that you keep. And how those records are kept will certainly influence how you would handle any kind of IRS inquiry or state treasury inquiry or anything like that. So, best practices. First thing, separate bank account. If you're having a business, you really want to keep a separate bank account for the business. This really applies to someone that's making, maybe $1,000 or more in gross sales. If you're just doing a couple $100 a year, you probably don't need to worry about this. But one of the biggest things the IRS looks at when they're investigating or auditing, forbid that ever happen, but are the business and personal checking accounts the same, or is there a separate account? So I always tell my clients, you really want a separate checking account. The money going in and out of the account should only be business related. Business income goes in, business expenses come out. Now, I understand that at times you might have to put some money in personally to keep the business afloat. That's fine. Or you might want to take some money out to pay bills. That's fine. They just need to really be documented separately. They are not income or expenses for the business, so you need to kind of keep those separate and keep them well documented. The next thing is some kind of accounting system. You have to be able to keep track of all these checks and money coming in and expenses going out. So the basic purpose for a bookkeeping system is really just to track all that stuff. And it makes your year-end tax reporting much easier if we do this. So there's a couple of easy ways to do it. The first one that I've seen, which is kind of old school, but it works well, is called DomeBook, D-O-M-E, DomeBooks. And what they are is they're pre-printed books in a spiral binder that already have a bunch of commonly used expenses listed on the side of the page, columns for putting in the amounts and vendors. And then these pages are either weekly or monthly, depending on which book you get, and they just roll forward. So every month you're just carrying the balance forward to the next month. So when you get to the end of the year, there's a summary page that gives you the whole year's income and expenses. You know, it's hand done, but it works, and it's a good summary. The next type of service I've seen is basically using Excel spreadsheets. This works really well. Does all the math for you. You don't have to worry about it. The only drawback to that a little bit is setting it up in the first place. You might need some help doing that. If you feel confident in your Excel skills or your spreadsheet skills and stuff, it's a really good way of doing it, because then the next year you already have it set up and it just continues on moving forward. The third type of bookkeeping is what I would call computerized programs, QuickBooks, things like that. I'm sure you've heard of them. There's online programs that do this. They're very efficient in what they do, and they keep records forever. So in that sense, they're really good. The problem with them sometimes is you have to have a pretty good understanding of accounting and a decent understanding of what you're trying to do in terms of tax stuff. So setting them up is the big start, and then maintaining them is another issue, but certainly doable. I actually use QuickBooks myself and have for 20 years. And there's lots of QuickBooks experts out there that can help you. The other thing is creating a filing system. While the bookkeeping is a good summary record keeping of numbers, in terms of the IRS, they don't count for anything. All those numbers need to be backed up by paper. So keeping receipts, keeping invoices, keeping billing if you invoice other people. All of those types of things need to be filed in some format or another. Doesn't really matter how you do it, just that you have some filing, that you're keeping the records for at least 7 years is the general thing. A lot of people think bank statements or credit card statements are good enough. They're really not. The IRS does not consider them source documents, meaning original documents, so you really need the paper. If you're somewhere and they ask, do you want the receipt? Yes, you always want the receipt. No matter how you decide to do the bookkeeping, biggest thing is to do it. I have set up so many small businesses over the years that the owner starts out great, and 6 months, 8 months later, I take a look at what he's done, and he hasn't done anything after the second month. Our memories are not as good as we think they are, and they get worse as we get older. I can tell you from experience. So do things regularly, consistently, weekly at a minimum, daily if you're that busy. If you're only doing things once or twice a month, do it the day after, so you have all that right fresh in your mind when you do it. That's about it for the bookkeeping. Tax implications. We're going to start with some basic stuff. This is something that is very complicated, but it may come up if you talk to somebody, a professional, about your taxes, and that's whether this is a hobby or a business. This is a very complicated and gray area within the IRS. However, the basic points that the IRS looks at is, are you operating this entity, this activity, for a profit? Are you putting in the time and the effort? Are you keeping good records? Are you maintaining a separation of personal and business expenses? Do you have the knowledge to run this business? Do you have advisors that help you with this business? None of these things by themselves would turn you into a hobby or into a business. It's all facts and circumstances, so each individual case is looked at differently. But if you're only doing $200, $300, $400, $500 a year in gross, the IRS may look at that as that's not really a business. It's just not big enough to be able to take any deductions or losses. So it's a question that if you talk to a tax preparer, they may ask you. So make sure you do all the documentation. If you do the bookkeeping well, that's a real sound way to fight off any IRS contention that it's a hobby versus a business. Okay. Change my notes here. So let's talk real quick about the basics. Income for the business is all cash received. Anything that comes in relative to the business is income. This would include non-cash type things like bartering. If you are bartering your service or your product for another service or product, the IRS really, this is a big place of contention with the IRS, because you need to include in income the fair market value of whatever service or product you got. And then you get to expense the cost of whatever service or product you gave to the other person. So I tend to try to get my clients not to do this in the business simply because it's very difficult, accounting-wise and tax-wise. But I know it happens. So expenses, tax deductible expenses. The general rule is, from the IRS perspective, that the expense must be necessary, ordinary, and reasonable. Okay, those three words are in the IRS tax code. However, the definition of those words is not. So there is a fair amount of gray area about what is necessary, what is ordinary, and what is reasonable. That's good for you and bad for you in the sense that there's a bit of leeway in what you consider necessary, ordinary, or reasonable. But the IRS, on the other hand, has a lot of leeway to shut down what they think is necessary, ordinary, and reasonable. So, common sense, generally speaking, is how I try to talk about that. So general types of expenses that most of my Schedule C sole proprietors would encounter: office expenses, things like letterhead, business cards, staples, pens and pencils. I mean, those are just office expenses, office supplies. Postage and shipping, product purchases, which through your business, I understand would be, all the things that you're buying to resell. Take note, for those of you who are doing over $5,000 worth of that in terms of buying from the parent company, that you should be receiving a Form 1099 miscellaneous with the amount that you bought from the parent that you were going to resell in box 9 of that form. That is not necessarily the amount that you're going to put on your tax return, but it is something that your tax preparer will need. Other things, just supplies, general supplies. These would be things like when you are hosting a nail party or attending a nail party. I'm not sure how you guys describe this, but say you bring food, you bring door prizes, you bring some free giveaways of product. Those are supplies. Those are things that you can expense right off because it's kind of a marketing deal. You could probably put it under marketing if you wanted, but I would tend to throw it in supplies. Speaking of marketing, obviously advertising, if you're putting ads in papers or on the internet or some kind of marketing advertising, those would certainly be expensible. Your telephone, most everybody now has a cell phone, so for small businesses, at least some part of your cell phone can probably be deducted. It depends on what other businesses, what other activities you might do on your cell phone. For me, my cell phone, I take 100% of it because when someone calls me on my cell phone, the answer, if I'm not answering it, answers it as McMillan and McMillan CPAs. So it's a business phone. If yours is just, hi, this is Joe, leave me a message, you might not be able to take 100%. Other things would be travel expenses. Now, travel expenses are hotels, tolls, parking, airfare, if you're going to the Orlando seminar or gathering that I just heard about, things like that are travel. Final one that a lot of people have is meals. It used to be called meals and entertainment. The IRS has essentially said entertainment expenses are no longer deductible, so it's strictly meals. And for meals, there are some very specific rules around them in order to deduct them. One of which, the biggest one, is documentation. Again, documenting the meal. So for that, they have several things that have to be documented. First of all would be the cost, obviously, the date of the meal, the place of the meal. That's usually all on your receipt. That's fine. The other odd things, though, are you have to document who the individuals were at the meal. And then you have to document what was the business purpose of the meal. So all those things have to be documented in order for the IRS to allow that to be deducted. Those are kind of general things that people have. And then the next two that I'm going to talk about are a little more involved, although they're very common. The first is the home office deduction. Anybody who's self-employed or has looked at it has heard about this home office deduction. First thing we need to know, or you need to know about that, is in order to claim it, there has to be an area in your residence. Could be a home, an apartment, a condo, trailer, doesn't matter. Could be your boat if you live on a boat. But there has to be a specific place in that residence that is used exclusively and regularly for business. Exclusively means not quite exclusively, but mostly 85–90%. If your office is the dining room table in your kitchen and the only time it gets used is an hour a week when you're doing something, that is not a home office. If you have a corner in a spare bedroom, even though there's a bed in there that guests might sleep on, but you use that corner exclusively for business, that corner of the room constitutes a home office. That's important when we get to the next step about how do we determine what the deduction is. Oh, regularly. Should talk about regularly. Regularly means on some type of regular basis. Doesn't necessarily mean daily. If you only work there once a week, but it's every week on the same day pretty much, that's regular. So it has to be regular, not once every 6 months you go in and do your accounting. So exclusive and regular. There are two ways to calculate this deduction. One is the simplified method, which is real easy. It's basically $5 times the square footage that you use for business, up to a maximum of $1,500 a year. So take the square footage that's used for business, multiply by $5, that's the deduction. Straight, simple, no documentation. Very rare for the IRS to give you something that you don't have to document. The other way is the actual cost method, which does require documentation, but also generally, depending on the size of your home office, will give you a bigger deduction. But for that, what you need to do is you need to take the square footage of what you're using as the business office and take the percentage of that to the total square footage of your residence. That percentage is then multiplied against the total of these following expenses. Mortgage interest, if you have a home mortgage, real estate taxes, rent, if you're renting something, the utilities, homeowners or renters insurance, condo association fees if you're in a condo, repairs and maintenance on the property, and that covers all kinds of repairs and maintenance. That means the weed spray you do, the flowering you do, the lawn mowing you do, anything that maintains the property is part of this. And then if you own the property, there's also a depreciation expense that you can get. There are sometimes some other odd things that come in there, but basically everything about maintaining the property times the percent of your square footage for business versus total is the deduction. Okay, so that usually for most of my clients will generate somewhere between $700 and $1,200 to $1,500 deduction. doing the actual cost. But you have to be able to document all of those things. So you have to document the maintenance, you have to document the insurance, you have to document the mortgage, which is not all that difficult. You get all those bills anyway. The second expense that a lot of people obviously know about is automobiles. And again, there's two ways to calculate the automobile expense, but the tough part really is what are the deductible miles? What are the miles that can be used to calculate this? So the IRS calls those personal miles and business miles. Trying to determine business miles can be a little complicated and probably too involved to go into overall with any particular individual because everybody's circumstances are different. But in general, business miles, deductible miles, are those that you would incur driving from, for example, if you have a regular job and this business, from your regular job to, say, one of the nail parties or to a group meeting that's talking about the business or to a, just a businessman's group or anything that's business related, and then the trip home from that place. That would be business miles. If you have a home office and you leave your office at 7 o'clock at night to go to one of the nail parties and then home, both of those trips, both ways, is deductible. If you're going, you got to go up to the bank to make a deposit. That's deductible. You have to meet somebody for lunch or a meeting. Anything business related is deductible miles. However, you need to document this too. This is another area where the IRS is very aggressive in going after small businesses, is mileage. I recommend all of my clients keep some kind of mileage log. I keep mine in a little, it's got to be no bigger than a 3.5 by 2 inch spiral little notebook I keep in the car. Every date, I write it down. Again, you have to document where you went, the miles, and who you saw and why you did it. Kind of like the meals and entertainment. You got to document all this. There are now apps out there that you can have on your phone that do this. So, however you want to do it, you need to document it. So once you've got the miles, the way the deduction is done, again, two ways, much like the home office. We can take the standard mileage rate times the miles. That mileage rate changes every year. Sometimes it changes during the year, but it's really nothing you have to worry about until the end of the year when you're figuring out the deduction, and that'll all be in the IRS new things going on, or your tax preparer will know all that. But that's the easy way. All you got to do is document the mileage. The second way, again, is actual cost. So for actual cost, you still have to document your business miles, and you have to document the total miles for the year, because like the home office, it's a percentage. It's that percentage of business to total times all of your vehicle costs. So the vehicle costs would include any loan interest if you have a car loan. If you have a lease, it would include the lease payments. Obviously gas, oil, repairs, tires, license plates, registrations, insurance, those types of things, anything. But again, documentation. Actual cost requires a lot of documentation. So most of my clients do mileage. The only time that actual cost comes in to do better really is when you're going to buy a new vehicle. You're going to use it for 3 to 5 years, and then we can depreciate that vehicle as part of the actual cost, and you get a pretty good deduction from the depreciation more than the actual cost. But most people just do the mileage. It's a lot simpler. Last thing about taxes, just some miscellaneous issues about taxes. The taxes that you're going to pay are paid on the net income from the business. So that's the total revenue income minus all the expenses, leaves you a net profit. That's what your taxes are going to be on. And the taxes you're going to pay are actually two different taxes. One is income tax. And that income tax is just whatever tax rate you're in, whatever tax bracket you're in, that's what that's going to be taxed at. However, under the new tax code, small businesses, Schedule C, sole proprietors, and some others, but for you guys, you get to take a 20% deduction of that profit on your tax return. So you're actually only paying income tax on 80% of that. But the other tax you're going to pay, which is on 100% of that profit, is called self-employment tax. And that tax rate is 15.3%. So that 15.3% plus your federal tax rate, plus your I'll say Michigan, but your state tax rate is the total tax you'll pay on the business. And I strongly, strongly encourage my clients to make sure that they at least quarterly look at what they think their taxes are going to be and put it aside to pay the tax. Even if you're only doing it in April, you know, the following year when you file the tax return, that it's put aside so you don't have to try to come up with it later. Speaking of that, there may be a possibility that you will owe quarterly estimated tax payments, both federal and state. Again, this is all dependent on your individual tax circumstances, and a good tax advisor, tax preparer can help you figure out whether you do, and if you do, how much, and get you set up to do that. There is no separate tax return for the business. People often think they have to file a separate tax return. You don't. What there is there's a couple of schedules that get attached to your tax return, your personal tax return, that record all of this income and expenses and then flow it through and add it into all the other income sources that you might have. That's it for the taxes. The last thing I just want to talk real quick about is finding a tax preparer. Depending on the size of your business, if you're netting, you know, 5, 10, 15, 20,000 a year through any of this or any other small businesses that you have, I strongly suggest you get a good tax preparer. Personal recommendation from someone is usually the best. Going off an ad or something doesn't usually work real well. You want to find someone you're comfortable with, someone you can relate to. You're going to be trusting this person with most of your personal information, your kids' personal information, your financial information. So you want to feel really comfortable with them. Hopefully this would turn into a long-term relationship. Most of my clients I've had for well over 10 years, some of them going on 25. That's the kind of guy you're looking for, girl, gal, or guy. Someone you can work with for a long time. While you should be sensitive to the cost, realize that this person has spent a lot of time and education to be an expert in what they do, and they're going to be an advisor to you in a lot of different areas. They're going to hopefully keep you out of any tax trouble and certainly help you if you stumble into something. Just don't expect, if you've been having H&R Block do your return or Jackson Hewitt, somebody like that, the cost is going to be more than that. But what you're getting is some peace of mind and some expert help. The other thing that you should be aware of is that you really want to try to find somebody who's accredited. And by accredited, I mean is either a CPA, is an EA, and an EA is an enrolled agent, which means that they are enrolled with the IRS, not as an employee, but it means they are qualified to represent you before the IRS, like a CPA or an attorney, and they are required to get certain continuing education credits every year. Those are the kind of people that you know are up to date on what's going on, have been in the business long enough, are committed to it, that they're going to be around next year. Those are the kind of people you're looking for. If you feel comfortable with your own tax knowledge and accounting knowledge, you can certainly do your own taxes. TurboTax is a pretty good thing. My issues with TurboTax is not the program itself. It's that people answer questions they don't quite understand, and often they answer them wrong, and that gets them in trouble. TurboTax does have a fair amount of research down. If you dig down into their questions, they will refer you to places. I find most people won't go and do that research, and they just answer the question the way they think it should be, and that can get you in trouble. But if you're comfortable with doing that kind of research and doing that, TurboTax, that kind of thing, those types of programs, they're very good. There's nothing wrong with them. You just don't get any real advice. I know this sounds kind of overwhelming. I threw a lot at you. But really, once you get started, if you get good record keeping, you keep an eye on the end use, which is really the tax preparation, and you keep yourself open to asking questions. Ask questions, ask questions, ask questions to everybody you know, particularly your tax advisor if you get one. After a few years, you'll stop asking questions because you'll have learned a lot. But I know you guys can do this. You're obviously committed. So best of luck to you. Thank you for listening to me, and I will certainly take any questions that you might have.
Thanks so much, Doug. Yeah, so if anybody has a question, go ahead and just unmute yourself, and then just please, if you do, once your question is through, just mute yourself so we can limit the background noise. So go ahead, Dar, I see you over there.
Yeah. I'm sorry. I do have two questions. So you mentioned for meals and such to have a paper receipt. And I know with certain programs that you might use for tracking your taxes, you can take a picture of it and enter it like QuickBooks. You can keep a picture of that receipt. Is that legal?
Yes. The IRS will accept a digital copy.
Okay. Second question is, you mentioned buying product and having that amount on your 1099 as a miscellaneous.
Yes.
I wonder, because we buy them as a customer. We buy products as a customer so that we can also get hostess credits for the nails. So I don't know if any nails that we might have purchased will get commission on those, but those might not be indicated on a 1099.
That would depend on how the parent company is handling it. Generally speaking, the way that's supposed to be handled is it all shows up on the 1099. Anything that you take out personally for your own personal use is not expensible. So if you ordered $1,000 worth of stuff and you took 100 of it for your personal use, your deduction on the tax return is $900.
Okay. What about if it's marketing? What about if, like, for our nails, personal use for our nails, it's actually marketing for us?
Well, okay. That would be a tax preparer's question, meaning how comfortable is he with that? For example, I once had a client who was in the entertainment industry, and she wanted to deduct some of her clothing because she thought that was marketing herself. The IRS does not look kindly on that type of stuff that is really more personal. When the IRS looks at things that can be useful both for business and personal, one of the things they look at is, can it be used only for business? For example, uniforms. If you have to have a uniform for work and it has your name on it and the business logo on it, that would be a deductible expense. But if it's just a blue turtleneck long sleeve shirt that you have to wear, the IRS would probably not allow that. So again, the fingernails is a tax preparer by tax preparer thing. I would tend to say no, personally. But the client, if you came to me and said, hey, I think it is, then what I would tell you is, that's fine, I will take it, but in my letter to you when I deliver the tax return, there's going to be a comment that my preference was not to do this, so that you're kind of taking responsibility for that. So if the IRS denies it, there's a record that I advise you differently. Doesn't mean you can't do it, just...
Okay. So oftentimes we are using them and putting them on a live to advertise our business. You know, like we're actually doing like a small commercial, basically. Sorry, I'm a little out of breath bringing stuff in from the car.
Well, like I said, it's a tax preparer by tax preparer issue. I'm
Okay.
not saying it's a gray area. I'm not saying it's yes or
Yeah.
no. It's kind
Okay.
of how you feel about it and how big the number is, to be honest with you.
Okay.
Now, using that same example, if you took 100 out for personal and 100 out for uh, door prizes, the 100 for door prizes is certainly deductible because that is marketing. That is certainly marketing. You're giving it to somebody to buy. Okay, that's a relatively easy one. When you get to personal use stuff, it's a gray area. There's a lot of gray areas in the tax law.
Okay, I understand that. Thank you so much.
Okay, no problem.
I had a question, Doug. Can you guys hear me?
Yep, I got you.
Okay. So I was wondering how it works with claiming, like if you paid for a business trip and airline miles, can you claim those airline miles based on like the average cost of what that, what those flights would have cost, or how does that work?
Actually, no. And the reason for that gets into another little more in-depth discussion of what is income and expenses. The miles that you got never were reported to you as income.
Right.
Therefore, and gets a little technical, you have no basis in the points. You have no tax cost in the points.
Okay.
There's no value to them. From the
Okay.
IRS perspective. There is to you because you get to fly. But from the IRS perspective, there's no value, there's no deductibility.
Okay. So in the future, probably for business, like for
For
business,
business, I would, pay for it. Yeah,
pay
if you
for
can
it
pay
in cash.
Yeah. Yeah.
Bummer. Okay.
Yeah.
And then my second question was, I know you had said like if you're giving away like door prizes or things like that at the actual nail bars, like a lot of us give away packs of nails through like our VIP group. So that would just be something that you could charge as a general supply or expense, right? Is the cost of us giving away a product for free, you know, for marketing purposes or, you know, as prizes.
Right. That would be the cost that you paid for it.
Okay. And so documentation for that would like, because I have just like an Excel spreadsheet with every pack that I've given away, just numbers, would that suffice?
Yeah, because really, and this would get, the only time that would really come into play is if they did a really in-depth audit and saw how much you bought and how much you sold. And so you'd have a discrepancy between bought and sold, but then you could say, well, yeah, but here's where the others went. They were marketing, I gave them as samples or whatever. Yeah.
Right. Okay.
So that's fine. Yeah, that documentation would be fine.
Perfect. Okay. Thank you.
Mm-hmm.
I have a question. So as far as mileage goes, do you have to record the actual mileage from your vehicle or just the number of miles that you traveled?
Oh, okay. So it kind of depends on which way you're going. If you're doing the standard mileage rate, all you really need is the miles from one place to another. If you're doing actual cost, all you really need is the beginning mileage on January 1st and the ending mileage on December 31st, because that's the total. And then the business miles. So no, you don't have, every day you don't have to write down necessarily 900. Ooh, wish I got 900,000 miles. 90,100 ending 90,140. No, you don't have to document it that way. Just the total miles is fine.
My second question real quick is if you travel to a out of state for family and you end up doing a party there, is some of that deductible?
The cost related to the party would be deductible, directly related, obviously, any supplies or anything that you did. The IRS looks at mixing business and personal travel as a weighted venture. So if you spent 3 days out of state, out of town, and you spent 6 hours at a party, the IRS would probably say very little of any of those travel costs are deductible. maybe a little bit of the mile, a percentage of the miles, maybe a little bit of the hotel room if you stay in the hotel room, but it'd be very little. Now, if you went there and did 4 or 5 parties and spent a whole day doing them, or 3 evenings, you might get a whole day's worth out of the 3 days. So it's kind of again, it's one of these gray areas that the IRS, nobody knows for sure. It's kind of a facts and circumstances thing.
Okay.
I have a question.
Sure.
So when we purchase these nails, say we, purchase a lot of nails, and then, we've paid for those, but now we're reselling them at the price that we bought them for. We can't write that off at all, can we?
What do you mean, write off what?
Well, we buy our nail strips from a parent company. Like, say we bought the Valentine nails, and there was, so many sets for $154 or whatever it was. Now I'm reselling those nails.
Okay.
So I'm getting another price, I'm getting paid for what I paid for them originally.
Oh, okay.
So there's no write-off in that, right?
Well, write-off means you get to write off the $154 that you paid.
Even though I'm going to receive money from somebody else for those nails?
Right. So you write off the $154 against the $154 that you paid is the expense. The income is $154 net zero.
So it's really going to be a wash.
It is a wash. That's true. If that's all you're doing is selling for exactly what you got, if you're selling for what you paid for, then you're probably not in this for profit, and therefore you're a hobby and not a business.
Okay.
So when we go back to the hobby business thing, if you're selling it for what you paid it for, nobody in a for-profit business does that, right? Everybody marks up.
Well,
So-
the point is we purchase them though, Doug, at the cost of that they are, but we make commission in a rebate. 25% of that comes back to us, even when we purchase it to resell it. So if I buy
Okay.
4 sets of
Okay.
nails
Okay.
at $10,
Okay. Then there's another piece here that I didn't understand about how
Sorry, I didn't really know how to ask that question.
about how this business works. Then
Okay.
I told you might receive a 1099 miscellaneous with box 9 with a number in it. I'm not sure, but I'm thinking that 1099 miscellaneous is also going to have a number in box 7. Or box 7 is non-employee compensation, which is self-employment income. Or in box, trying to think where, it might be box 3, other income. My thought would be that the parent company is going to report to you somehow the amount of commissions that you got. That is going to go to the IRS as income to you.
yes,
So
that's what it's on our 1099s.
Okay, so that is the number. That changes a little bit, but not a lot. That is a number that the IRS is going to get. So that number on your tax return, or I should say the number on your tax return, needs to be at least that amount, maybe more, if you have some other stream of revenue from this business. If not, it would be that 1099 amount. So if, for say, you marked up the nails a little bit, then it wouldn't be the same as the 1099, it'd be greater. But it would never be less. The gross income would never be less than that.
Doug?
Yes.
Yeah, this is Matt. First of all, thanks a lot for doing this. This is a big help. Get me thinking the right way. I'm
Right.
trying to help my wife with this home business. A question, okay, does everybody generally just do a sole proprietorship with this business, or does it really have to do with size and revenue stream? That would be my first question.
Okay, let me answer that one first. Considering the type of business this is, most of them are sole proprietorships. If you're thinking anything like a limited liability company or a DBA, those things are all possible, but there are other tax and legal implications of those.
Sure.
But which I'm not an attorney, so I can't advise you legally about that. But most of these types of home businesses or direct sale type businesses are just simple sole proprietorships.
Very good. Okay, and another question, and this is how my wife is kind of struggling with this one, or maybe I'm struggling with. She's talking about, what the ladies were talking about, which is buying product. And when she buys her product, she uses hers for giveaways. So whatever she would spend for the product she expenses that because she's giving them away. She hasn't sold them, right? She doesn't record income if she's giving them away, right?
Correct.
And then additionally, whatever she gets in commission would end up on her 1099. Is that correct?
I believe so.
Okay. And then it sounded like you said something about a $5,000 threshold for the 1099 miscellaneous. Is that a threshold?
That was the threshold for product. The
Okay.
threshold for commission type income would be $600.
Okay.
So if the commissions are above 600, assuming I understand how the parent company is handling this, because there's a couple of ways they could handle you.
Right.
And a lot of these companies handle them differently, and there's always issues with the IRS sometimes about how they do that. But for a 1099 miscellaneous, other than the product, it's usually a $600 limit. So if it's under $600 in commissions, you probably won't get one. If it's over that, they're required to issue you one.
You won't get one, but you still have to pay taxes on it, correct?
You should.
You should. You
I
should.
just want to make that clear.
Just saying, you should, yes.
And I've run a few businesses, and when it comes down to whether or not to send the 1099, if you get over $600, you have to. But if you're under $600, you still can send them a 1099.
Correct.
Yeah.
Yes, you can still send it.
It depends on the discretion of the company, right?
Yeah, 100%.
So I don't know. I have no experience with this previous here in this business. I don't know. Has anybody gotten a 1099 through this that was less than $600? Does anybody know that?
Color Street's only sending them if you're over 600.
Okay. Thank you.
Yeah.
There we go.
And you could fill that stuff out online to see it online, or if you didn't, then they'll send it to you.
Okay. And while the group can hear me, can I ask, does anybody have a real good handle on the back office piece of this? Because I haven't even started looking at it yet. And do any of you ladies have a real good grasp of how the back office functions in case I was to have a question?
For tax purposes, you mean, or in general?
Yeah, just in general.
Oh, like as far as placing orders?
Well, no, I guess, being able to see order volume and revenue and expense,
It's not going to show expenses, but you can look up your own personal history for orders, or you can look up customer orders if you've been ordering as a customer through your name.
Okay.
And you can print, usually when I order nails, I'll print the invoice of what I've spent. So I have that set aside.
Okay, this
You
is
can
our
also see the history of commissions in the back office, too.
What's that, Dar?
You can also see the history of commissions in the back office as well.
Oh, yeah,
Okay.
yeah.
All right. Thank you all for your help on this. And like I said to Doug, it was a big help for me just trying to get my head around what we need to do.
Happy to do it.
Yeah, and everybody too, just anybody who's won, like there's some cruise winners on here. Remember, anytime you win, like luggage, all that stuff, they will be counting as income.
Very
So-
true. I did not know they did that. But yes,
I'm pretty sure they will, right? Don't they do that, Doug?
it'll
Yeah.
all be showing up at fair market value.
Yep.
But be aware of that because it won't show up on your bookkeeping.
Right.
I have a quick question about that then. Is that cruise is in 2019? Is it on 2019 taxes then?
Right. You won't see it till
Okay.
next year.
And then
So
another,
last year, I don't think we really had prizes last year that you would have.
Okay. And one more question along that also. So let's say we paid for our flight for that cruise in December of 2018, but the actual flight isn't happening until 2019. Where does that expense fall?
Well, this flight is a personal expense, isn't it?
So it's I guess that's the question. It's a business.
Is the cruise oriented around the business, or is this a reward for you?
I think
I don't
it's
know what the cruise is exactly.
I think it's a combination of both. As leaders on the team, there'll be leader training along with.
Okay, so there will be some business.
Company-led cruise that some people have earned, and there will be training and that kind of stuff on the cruise.
Okay, so that kind of goes back to a previous question about separating time. How much of the cruise is business and how much is personal. And so you're going to end up taking a percentage of all of those expenses that you pay, airfare and whatever else you might have, and deducting some of them. I would be very hard pressed to deduct 100%, simply because 100% of your time is not on the business. There might be, I know that in my business, in my profession, one of the big things is continuing education classes in Puerto Rico or Hawaii, and you get a week there, but you're only actually in class 6 hours a day. Well, that means out of that time, I have to add up 6 hours, how many days, come up with a percentage of the total days. That's how much is business. So it'd be a similar thing here. How much time are you actually spending on business versus non-business? And so a percentage would be deductible. That's how I would approach it.
I have to be honest, I look at the whole thing as business, because you'll be networking. Since you're with the whole company, you're with the owner.
You're not with the family.
Right. I look at the whole thing. The whole time you'll be on working. You may be having a margarita with it, but you are. But
again, a gray area. Again, this is not cut and fast.
Right.
My general rule has been, and I don't have a lot of these, to be honest with you, that have done that, is the IRS would look a little harshly at 100% business deduction for that type of event.
Because their only deduction really is going to be your flight there. And then.
Right. So again, it may not be a big dollar amount. And this is where the risk, this is where, as a tax preparer and a client, we talk about how much risk do you want to take. Yes, you can probably try to argue 100% deductible. The IRS could argue less. Is it a big dollar? If it's not a big dollar, IRS probably wouldn't worry about it too much. But those risks add up. So if that's one risk on your return, and there's 4 or 5 other places where you've got risk, one of the things the IRS looks at in an audit is how reliable is this taxpayer? Meaning, if I only find one area of concern out of everything I look at as an IRS auditor, all right, I'm willing to believe or to be a little softer or a little easier. But if I find multiple issues where the taxpayer is being very aggressive, then I start getting aggressive because I know there's something there. That's all I'm saying. There is no black and white. This is, a lot of tax law is very gray, and that's why it makes this job fun and sometimes difficult. So again, that's a personal thing. I can't answer individuals because it really comes down to the individual, their circumstance, and what the preparer is willing to risk, because he puts his name on this tax return too, which does subject him to penalties if there are issues. It could be anyway. So I understand and I appreciate your thought, Debbie, that yes, it is very much a networking issue.
We're growing a business.
This is only for the surprise nature of the trip you guys are taking in 2019. The conference from 2018 is fully deductible, right? Airfare and hotels.
The conference, how many hours a day is the conference?
All day.
All day and night.
All day. Then it would probably be fine. If you fly in early, like if you fly in the night before, that's probably fine. And fly out the morning after, that's fine. If you fly in 2 days early to enjoy Orlando a little bit, those 2 days, now we're getting into the percentage thing.
Gotcha.
Now, again, Debbie might argue, and I can see this, well, but we're networking with people who are here early. Okay, I mean, I can see that, but generally I would look at that, you're getting there early to enjoy Orlando before the conference, or staying after, whichever. But
So when she went to Vegas and went over to one of the casinos to spend $50 betting on the Lions for me, that doesn't help my case, right?
no, and the $50 isn't deductible.
$50
Only
is
if you
gone.
won a bunch, then they want taxes on that.
Yeah, if you won.
Okay. That's not a concern.
Not with the Lions, no. My Bears, maybe. But they got beat out too, so.
This has been great. Thank you so much for everything.
Oh, not a problem. Not a problem. Like I said, I worked with Annette for a long time, and I know she's dedicated to what she does, and she's grown a lot. So I know this helps, and I do it with clients all the time. Usually
I've had a good teacher when it comes to my business.
Not in a group.
Are there any more questions for Doug?
No, thank you.
Thank you so much for being here, Doug. We appreciate you and
No
appreciate you
problem.
taking your time.
Thank you all for listening.
So much. Thank you.
Thank you so
Thank
much.
you. All right.
Good night, everybody.
All right.
Thank you, Doug.
Thank you.